Hello, everyone. Welcome to Market Trends with David Russell. I am the global head of market strategy at TradeStation. It's great to be with everyone. Um, Wanted to welcome you guys back to Market Trends. We do these every Thursday afternoon at 2 p.m. Before we get started, I want to just show you some disclosures here. Now, in addition to this, if you go to tradestation.com and you go to the Insights link on the top, it will take you to our blog. And on our blog, you will find an article with some of the main points we're going to talk about today. Now, there was something actually strange happening to the blog on some of my browsers. I'm not sure if other people are seeing that, but it was not showing the article at the very top the way it should. It's one of those strange things when sometimes I'm not sure if it's a caching issue or there is something on the website. But regardless, if you are having any trouble, finding the blog post, you can go to the YouTube stream right now, and we are and on that YouTube stream you'll find a link to the blog post that actually covers everything. So we're going to start off as usual with our standardized returns of select ETFs that we may be discussing today. So we'll take a look at those. I'm going to put some disclosures also in the chat. If you have any questions, go ahead and ask in the chat, and I'll put these in. As always, it's great to talk with everyone. Okay, so this is the post we had today, and what I said was potential bear flag is the news worsens. And so for me, it's kind of interesting setup when you look at the S&P here, the way we've broken down below an interesting level. And there was a close on April 12th. And let's take a look now at the ES chart we have here. Now, remember, if you go here and you've not done this yet, if you go to these downloads, there is a zip file, and inside the zip file, there's a series of workspaces, and those workspaces also have ELDs associated with them. Now, if you're new to TradeStation, our ELDs they're basically little libraries that have a series of indicators that you can load and then bring into your workspace and actually see some of the different indicators and things that we're using. So the workspaces we're showing you are in that zip file. These are customized things I've kind of created to help people find opportunities in the market, analyze the market, and sometimes for finding ways to actually act on those. Now, this is one of my favorites. This is the ES, or the kind of S&P index trading workspace. Now, the signals we have on this is basically the idea of looking for a combination of patterns. One pattern on this one, this is the S&P hourly chart. When the 50-hour moving average is falling, that would be considered a bearish signal. When the stochastic is overbought, that is also a bearish signal. If you have two of the three in place, it may be a potential opportunity. So in this case, we had the 50-hour falling. We can see that from this red histogram down here. Now, that red histogram is a custom indicator we've created, which shows the speed of the moving average. And you can see here that it's negative throughout this whole time here. That's a negative. That's called the MA speed. You can see it's falling. So that's a negative. And then stochastics went overbought. That's a negative. Right here this morning, there it was. And that basically had a decent drop of about, 30 or like maybe 40 points or so from that signal. So I want to point out that's one of the ways this thing can be used, and it had a decent signal today. Now, in some ways, you could say it had the same thing yesterday, where it went to this overbought after the Fed. Things like Fed meetings can be difficult because in some ways, everything is just going to be binary, and some of the actual trending signals might not be as meaningful. But this was an interesting example today. So the levels I'm looking at here, if you look right here, this is a Friday the 12th, you can see that this was the weekly close, and we went back up and we basically stalled at it. And then the next level after that, that I thought was potentially coming in, there's a level around 50.80. And that was basically a level from, you see, it was the highs when the market dropped and it went up and tried to make some highs. And what's interesting is we were right at 50.80. That's exactly where we were not able to close above on the hourly chart. So very often after a move happens, rally, pull back, and that first level that you'll bounce at can then go on to become support, and the same thing with resistance. So here we saw this level around 50.80 came into play. You'll notice how this level had kind of been a peak, and then it came back and was a peak on the 23rd with the downside, and now 50.80 is the one that was jumping up to me. So now I'm kind of watching the recent low around 5,007 or down to kind of around 5,000. And so for me, what's interesting here is that if you look at this on the daily, this can become a sort of flag of the initial move down and then potential bearish flag. So I think it's interesting to realize that we're in a really kind of a kind of a it could go either way sort of environment, because on one hand we have kind of an increasingly negative sort of set of news that we've been getting. The inflationary news has not been good today. Some of the data we got was really continued to be not very good in terms of what it could mean for interest rates. And I'm going to get into that. But then we also have, and it's important not to overstate the bearishness, because what we also have is we have a lot of cash on the sidelines, and there's not a lot of leverage money on the long side. So I think right now we're in an environment where the ability to have continuation to the downside and real follow through to the downside is limited, because there's not a lot of people who really are going to have to be liquidating and force selling. That's really what causes a real cascade to the downside when people are leveraged long. And there's not a lot of evidence that that's where we are in the market. There's a lot of cash on the sidelines, and sentiment has come down pretty sharply. If we look at our AAII survey, we can actually see here that we came down to 32% bullish recently, 38. These are the lowest levels really since November, back when the market started rallying. So we're in a spot here where, it can go either way. And what my sense has been is that we might move sideways here for a bit and kind of see how the data develops. What is interesting to me is if you look at the next set of data, this is the Cleveland Fed. The next set of data that's going to be coming out, the April number, it's forecast to be CPI 0.4 month over month and an annualized reading over 3.5%. So this is one thing that I think we have to be wary of coming up on May 15th. This is kind of hanging out there as a potential sort of risk. But nonetheless, the Fed is continuing with their kind of dovish position. Yesterday, they kind of continued to say that they're going to reduce QT, meaning that they're going to be on the margin starting to turn toward dovishness. They're going to be less, letting less of those bonds run off, which means that that's going to be essentially more of a net buyer or less of a net seller of treasuries, which is essentially a dovish sort of position. And this is the direction they want to go in, and they haven't changed that direction yet. So I also think it's very important to remember, tonight we have Apple, tomorrow we have non-farm payrolls. So if something is going to happen in terms of this bear flag resolving to the downside, you can see it on the hourly chart here. We can just make even a drawing, if you want to, see this is a potential line right here. If this is going to resolve to the downside, tomorrow could be that time. But in many ways, if the numbers tomorrow are more favorable, the whole thing could be undone. So I think it's important to realize that this is one of those days right now where we're probably not going to get much follow through one way or the other. I will say that on a daily chart, what's interesting here is if you look at the S&P on a daily, is that we actually did have yesterday an inverted hammer. And that is a potential reversal pattern. In my opinion, individual candles have not been very significant or lasting in their signals. And to me, this could be just viewed as another just kind of part of a sideways movement, waiting for the event that will tell us what's actually happening. So this is the MTES workspace I share with you guys. This is normally the cash index here. I have an hourly chart, and then we have the futures, also an hourly chart with these indicators. So remember, these indicators are designed to go with the futures. And when we look at this right now, there's really kind of no signal. On one hand, MACD is rising, and then at the same time, the stochastics are getting overbought. But at this point, the opportunity in terms of any signals coming off of this chart seem to have passed. So I want to just point out that this chart is one of the things we include, and I have found this to be often, a kind of informative thing to look at. All right, so they look at the overall things happening right now. Let's take a look at our, we're going to go to MT main, and then we're going to go to our key ETFs tab. And I'm going to look here on, the 21-day because we're seeing something very new happening, which is interesting. So what we're doing here is now we're ranking these ETFs that we can use essentially as indexes to show us where there's strength or weakness in the market. We want to find, I'm always focused on areas of focus on thematic sort of things happening. Individual stocks can be, great, but it's often useful to start with the sectors and the groups that are actually outperforming, and then kind of look for opportunities within those themes. Very often, that can give you more of an edge. And what is jumping out here that's very interesting is that China is outperforming. In fact, I'm going to add FXI to this. FXI is on the other page, but KWEB and FXI have really come to life in the last week or two. Even just today, I mean, they're up a lot. So what's interesting about this, and I have it in the articles I'm going to go through, but about 3 weeks ago, the Chinese decided that they wanted to be nice to investors again. Now, we were exceedingly negative on China for a long time, particularly like FXI. And, on this webinar, we've talked about how the country has a debt problem and all that. But in some ways, the biggest problem was, that their government was wanting to crack down on speculation and different kinds of things like that. But there was an article in the South China Morning Post, I think it's called. It's their big Chinese, it's one of the big Chinese news publications that often has news on the Chinese stock market. South China Morning Post, I think it's called. And they basically said that the Chinese security regulators were going to start essentially being more favorable toward investing and trading and stuff. And that was a huge change versus back here when they wanted to be cracking down on people left and right. So I think right now there is something very different. And in a country like China, given kind of its the way that it works, I mean, if they're going to decide to go one way, then that's the way they're going to go. There's not going to be as much back and forth. There's not going to be as much uncertainty. So, the negativity that we've described toward China for a while now on this webinar seems to be essentially ending. And it's interesting. We wrote about it in our recap. If you look here in the things we do on our blog and look at the article that we did recently, I think the one we did on Monday here, the NASDAQ surges, we actually highlight some of these things that were happening with the Chinese chips and China tech. So we actually talk about some of these things happening with the Chinese stocks. And this is very interesting to me because this area has been dead for a long time. And, if you want to be unhappy about American valuations, the Chinese valuations have come down a ton. And so I think this is something now where people are coming back to a major part of the market that has been dead money now for, it's hard to believe it's been over 3 years when it really stopped. This thing really started selling off in early 21, if you look back on this. So, this was even before the overall market rolled over. This was this route. And then this was when they started cracking down. It was and I'm looking here at like mid 21. This peak was February of 2021. So that's more than can you believe it? 3 years. It's been a long time. So this is, I think, an important thing we need to pay attention to here. And we're gonna get into some of that. So some of the things that are important on this one are FXI, KWEB, BABA, JD, PDD, which owns Temu, and Baidu. So here's one of the things we can do. We can go into our price grid, and we can just go now. And if we add some of these, PDD, KWEB, BABA, JD, PDD, and Baidu, you can see these trade a lot of options. And that's one thing that can be useful. Now, I'm going to take this same list. I'm just going to copy here real quick. I'm going to put it over in MA Tools. Excuse me. Now look at this. We'll see something here really interesting. Price grid right off the bat. We're going to see in price grid that we're way overbought on the Keltner. This is over 100, which means that there are more than an entire Keltner channel outside of the Keltner channel. So the Keltner channel is an average true range projected off the 20-day simple moving average. So look at JD here. Now, JD is a Chinese e-commerce company. My Keltner channels is these dotted lines here. So if this says 100, if the Keltner pullback says 100, it means you're at the top of the Keltner channel right there. If it says 200, it means that you're, in this case, the Keltner pullback is 232. So they are massively above their Keltner channel. So some ideas about something like this, if people are interested. in following some names like this. And when something is starting to move like this, in my view, the Keltner channel might not even be especially useful. I think it's one of these things that when something has a strong move like this, it's a signal that there's something significant happening in it, and you might not have much of a pullback in them. So what's interesting is using our MA tools, we can go here and we can go to our EMA test, and we can see when things pull back and hit like the 8-day exponential moving average or something like that. I'm pretty none of these are even on the 8-day, but for example, I'm going to just show you the NASDAQ 100. I'm going to go to data, add symbol list, NASDAQ 100. And now you're going to see, all right, here's a stock like PayPal. See, it lights up 8 EMA. That means that PayPal, and if we look here, is now touching its 8-day exponential moving average. You can see right here, it's that blue line on the chart. That is a potential sort of alert. So for stocks that are moving quickly like this, one potential idea, if someone was interested in trying to follow some of the strength of these Chinese names, is to put them into our MA tools and then wait for EMA, for the 8 EMA to light up and actually tell you. And if you look like on semiconductor, for example, today is touching that 8-day. I mean, in and of itself, it's a very tactical signal. It's not telling you a stock is good or bad, but it's telling you that a stock is having a short-term pullback. And you'll notice that it also highlights if it's green, meaning it's a rising 8-day, versus red if it's a falling 8-day. So look at, analog devices, ADI. You can see it rallied up, hit that falling 8-day exponential. It's falling here, so it's red in the radar screen. So that's how we use it. So there's some of the things to be kind of thinking about now in terms of some of these names. Quick pullbacks in them might offer opportunities for selling, some puts under them, put spreads and things like that. At this point, that's something you have to kind of wait to see happen. But, this is, I think right now, something that's potentially pretty interesting. It's been dead for a long time. And the other thing is now, I think when you look at it, there are certain kind of concerns if you look at the situation overall with the United States right now, because treasuries are really, the fiscal situation is actually getting pretty bad if you actually look at the data. So look at this. This is from the Treasury Department. The borrowing estimate is $41 billion. So basically Treasury announces their borrowing estimates for the second quarter. So basically they say is we are now going to be borrowing, where'd it go? 243. It used to be 202. So they went up 20% of their borrowing needs. Now, mind you, this is at a time of the economy growing, and they're talking about lower tax receipts. Now, honestly, to me, lower cash, this doesn't make any sense. I mean, to me, this is like, this shows that like the spending and fiscal situation is like, kind of, not doing great. Now, this is not political. I mentioned not trying to make any political commentary or anything like this, but the actual numbers that we're seeing that would be associated with treasuries are not great. So this is one negative. Another negative was this thing we got today from labor productivity. This was, where do I have? It doesn't, I had highlighted it. Oh, here it is. All right, look at this. Basically, labor productivity up 0.3 versus 0.8 estimate. That's not good at all. And then if you look here, unit labor costs way higher than expected. So this is also a negative for treasuries. Now, it's important to realize that this set of numbers was the same thing that launched the S&P higher. If we look back here to, when the market started rallying way back here, it was because of these good revisions to the, it was because of the unit labor costs and that stuff. It really showed it was pointing in a deflationary direction. A lot of the data this week was really not good. If you look at if we look at our data, I don't know if I have it all, the articles to it, but the Institute for Supply Management showed a really sharp spike in prices. If we look here at ISM, let me see, I think I've got it here, ISM World. I don't know where that, I clicked on a banner by accident. All right, so look at this ISM. We look at the ISM, Institute for Supply Management Manufacturing Index. It has a series of little sub-indexes in it. If we go here to the manufacturing, this is a great thing. I mean, I love reading the ISM reports. It has all kinds of cool people talking about stuff. But look down here at this prices. This is a huge spike. 60.9. That's big. Now, what's worrisome about this is it was the ISM prices way back in late 2020 that were the first things that told us inflation was picking up. So what worries me about this is we're really not seeing confirmation that inflation is coming down. This is not telling us, and I showed you that Cleveland Fed nowcast showing, right now we're going to have 0.4 month over month in April. These things are, to me, something to be kind of, wary of. So the employment cost index, which is similar to the unit labor costs and stuff, was higher than expected in Q1. In the GDP report, the core PCE was higher than expected. So right now, I think we have to realize that backdrop is something that creates a broader risk for, to a certain extent, the American stock market. And I think investors now are looking, when you see the strength that we've seen in gold, when we look at now the potential for something that be happening with Chinese stocks, we could enter a period that is kind of a mini version of the 70s where people are worried about inflation, gold does well, global stocks do better, America lags. And I'm not saying it's going to last as long as the 70s. This might simply be a few months while the market chops and consolidates. During that time, China outperforms, gold maybe, I'm not sure exactly right now when I look at precious metals because they've pulled back, and with the yields moving higher, that's not necessarily an opportunity for them. But we simply could be in a phase where the global does well again, and China is the most sort of prominent and popular of the global sort of places for active trading. So one, just point out that we're in an environment right now that might kind of argue for that. All right, let me just close this. To go through these. This was the unit labor costs I mentioned, Institute for Supply Management I mentioned. I talked about AAII. It's always good on Thursdays to look at AAII, the American Association of Individual Investors, their survey that comes out. Now, another one that was just popping up to me that I honestly thought that the Caterpillar was earnings reported. So, people might kind of look back on and say, this is like not terrific. When you really look at the data, if we look here in my rundown, what we actually see is we see that GDP missed by a country mile and inflation was higher. Then you look at Institute for Supply Management. Like I said, it was actually contracting, but prices shot up. Then you look at things here like even the construction spending showed way more strength in the public sector than the private. So what I've been seeing here is much of the recent strength in hiring and construction have been public and government, or it's been non-cyclical. So what we're seeing is parts of the economy like healthcare, education, and government doing well in terms of hiring and stuff like that. Meanwhile, the manufacturing has been bad. Economically sensitive things like, Caterpillar, or Starbucks, McDonald's, those have not been good. It's also interesting to take a look here. Look at like Marriott, economically sensitive, had a good earnings report, couldn't hold the rally. So I want to just kind of point that out because there are some signs here now of kind of the economy, parts of the economy really not doing great. And at the same time, inflation getting worse. You put those two things together and it is a potential for something that is not really all that great. And then when you combine what we see with something like Starbucks, when you see companies like this, also, so look at Estee Lauder. The point is these are consumer sort of, companies, Ulta, the beauty companies, it just kind of shows that there's a lot of areas out there that are really not, the parts of those of the economy like that, of things like Starbucks and a lot of McDonald's. If these things pull down the overall earnings growth of the S&P 500 and interest rates stay high, then in many ways it becomes more difficult to kind of justify a significant move higher in the S&P here. So I think that's the environment we're now in. We enter the year assuming the Fed was going to cut multiple times, assuming inflation was going to come down on the shelter side. Shelter is the single most important thing. If you actually look, it's more than a third of the index, and everyone assumed, including myself, we had this big assumption that shelter was going to come down. We looked at the rents, and those were coming down, but then it never came through in the CPI. We look at all the inventory of multifamily coming online, and in many ways, for whatever reason, that shelter component has not come down, and it's kept inflation in that high place. And then at the same time, we've got another surprising things. like this auto insurance thing popping up. We've had other surprising things like the healthcare just kind of kicking in, and even last CPI report, the apparel was higher. And so one little just thought I have is that companies, last year we didn't see a lot of inventory build in manufacturing companies. There was a lot of inventories really stayed low last year. But the problem is the way you're supposed to drive prices down, if you're the Fed, is inventories. People have to cut prices to clear inventories. Well, there was never a lot of inventory to clear. And so my concern now is with businesses having tight inventories, if the economy continues to do well, those companies have pricing power, which means that there's not the same kind of potential for inflation to come down. So, in my view, I think we now have an environment where things are just not as clearly positive as they were. Now, it doesn't mean the market's going to go down a lot. I would say that if you look overall at the S&P, one of the main levels that I'd be watching over the longer term was this level from January 31st, which was the close at 48.45. In my view, if things do get ugly, like tomorrow, if we have some kind of hot inflation number, not inflation, but payrolls number, if we have a bad earnings report from Apple, say things do break in that direction, the level that is kind of next on my list of watches is January 31st close. Because you have these other levels here, but we're already gotten pretty close to those, and these levels from basically the low from February 13th, things like that. But if things want to kind of get bad, in my perspective, these would be at risk, especially when you have this. I mean, if we break to the downside here, this is going to be a textbook bearish flag, and there could be a lot of momentum, people piling in and looking for follow through to the downside when you have a bearish flag like this. And if that is the case, then in my view, this would be the most logical place to look as your next strong sort of area. This kind of, what was interesting was this was a nice kicker to the upside on February 1st. The market broke down and then it rejected right back. And anyone who sold that day felt stupid the next day. And so for me, this area here is the next kind of important spot of price from the end of January, beginning of February. All right. Now, there are some other things that are out there. I don't want to be overly negative because, like I said, this is there are negatives happening with the treasuries, but at the same time, we're not trading treasuries. We're not economists. We're looking for the overall market here. And like I said, there's not a lot of debt in terms of leverage and people who are going to be forced sellers. There's a lot of cash on the sidelines. So it is not an environment that has that huge kind of, potential to really jump in that direction. So let's look at some of the things that are out there, because it was interesting to me is PayPal. Let's look at now some things that are maybe potentially interesting to be, looking at some various sorts of things people might want to do with options. It's always interesting to look at names like this after earnings. And I'm going to add MACD to this because I've noticed that sometimes you'll get a company that has good earnings, but the MACD is bad. And what will happen is the stock will sputter, and then a few weeks later, it will move. And so here's MACD. I'm going to add to my chart. So if we look here, you can see that, MACD had been falling on this one, and it's just starting to get positive again. The stock had earnings, and it basically held here, and it just came down. And what's interesting now is to see how it's holding above, the 8-day exponential moving average. So this is one to me that I looked at the call spreads, and honestly, the risk reward on them was not, in my opinion, very good. And I was looking at it. So let's take a look here. If someone wants to pay money for options on this, say you look at something on this one like the Junes. If you look at like the June 70-75 call spread, if you click on the ask, and then you hold down control and click on the bid at the 75s, you can see it's cost $1.20 for a $5 spread up to 75. And in my opinion, that's not a good risk reward. That's the odds of it getting to that level is, who knows? I mean, maybe if it's great, you could justify and see, hey, there's a potential for a breakout. In my view, when you look at this chart, there is some resistance here, and this thing might chop. And so this might be one where people want to think about selling a credit spread under it instead. So what I was looking at this is something like the 66, 64. And now this is, if we're buying options, people want to be thinking farther out in time because, options lose most of their value in the last 8 to 10 trading sessions. So, for people looking for something that might be kind of, putting time on their side, it's, taking the other perspective and going up here to the 10th of May, because now we see we have 8 days to expiration. A person could potentially, in this case, if they want to think about selling the puts, they would click on the bid and they'd hold down control and then click on the ask. And in this case, you have a 55-cent credit, 54-cent credit, selling the 66s and buying the 64, which is essentially, a 1 to 4. And for a put spread, that can be an interesting sort of risk reward. Now, the other thing about something like this is 66 is right here at this level. And so from my perspective, this is a thing where this is showing up as support, and people wanting to own the stock after a good earnings report might be looking right through this area. Now, what's interesting is I've noticed that when stocks are moving higher on good news, often the pullbacks are simply not very strong. So what's interesting about this to me is this could be an opportunity for people where, you essentially, the position would be profitable as long as the stock remained above 65.5, which is, right around yesterday's low. So this is just something where it's a potential where paying for the options to the upside is not necessarily going to have a terrific risk reward, but also something like a put credit spread would essentially let someone make some credit from the stock essentially sitting where it is. If it pulls back to a certain extent, you're going to get an entry at a lower price. And if it drops a lot, if it drops under 64, those puts that you own would protect you. But for a name like this, it's just kind of chopping after some good news. This might be something that people would look to kind of do. This was an interesting company. This company was, an absolute monster during COVID. And what's interesting here is that it's, pulled back really sharply. There was something about their business model that I don't actually, fully understand the intricacies of why they do well or don't do well. But there was this was one of the weirdest things I've ever seen back during COVID. I remember they had a bad earnings report, and then like the next day they raised guidance or something, and the stock went from being down decently to being up big time. And then it had this crazy run, and then it's just been dead money since. Now, what's interesting is they have a new CEO. So let's see if I included it in here. I mentioned it. So we have another article here. If you look here, we did an earnings recap. You look at here, we have on the blog, we have a few different articles. The AI boom fades article. We talk here about PayPal, and it's kind of interesting because they actually, somewhere in this article, I talk about PayPal. It's interesting because they're changing their business model. And when you have a company like PayPal, in some ways, it's always going to have huge volume. So if they can make little tiny changes to the way they handle their business, small changes in the business, when you translate it across gazillions of transactions and billions of dollars or trillions of dollars, for all I know, of actual volume that goes through a company like this, you're looking at a company that has so much volume. Small changes in the business can actually result in significant improvement in the results. And that seems to be what they're doing. I think it's interesting. We talk about why do stocks move? 7 catalysts for stock movement. We've talked about it in our previous blog post. One of those is business transformation. So this company has certain hallmarks of a business transformation. One of them is they're talking about a new business model. They changed their reporting metrics, which is interesting. And they have a new CEO. This guy came in from, I'm not sure where. I mentioned here in this article, but the key thing is this company could be in the midst of a business transformation that seems to be working. It also has washed out and really taken a beating now for a long time. So I just think it's interesting to kind of recognize this in a name like PayPal that a lot of people have probably forgotten about. So this was one to me I want to just kind of point out. Now, just in general, if the market does hold and want to rally from here, I think it's important to realize the two massive stocks, Netflix and Meta, have had some really big pullbacks after earnings, and they're both sitting at the 100-day simple moving averages. From my perspective here, if the market, wants to bounce, these might be some that have decent risk reward, to the upside. So I would almost say that in some cases, tomorrow, like if the market bounces, these would be ones that might simply jump from that news and have a 2 to 3 day move up to fill some of those gaps that they have. So Want to just kind of point that out. These are two major names, and their earnings were not really bad at all. They both had things forward looking that worried people. People didn't like the way Netflix stopped reporting their subscriber numbers, but the actual earnings were good. And I would say that, the thing about Netflix is now that they're including all these free users who pay, what do you call it? Who have to watch ads and all that stuff. In many ways, the subscriber matters don't matter. And then the other thing is, I don't say they don't matter, but they're not the same as people paying. But one of the other things is that in some ways, it becomes like PayPal, where you have a vast amount of volume of people doing stuff, and you can make small tweaks. It's no longer a growth story. It becomes a margin story. It becomes, how do you make more money from that? And then, I'm just saying, that's when you start seeing things, when they announce different kinds of deals, when they announce marketing things, and who knows how it works, but they can start coming up. They might have partnerships with other companies or something that suddenly moves the needle on stuff. And that's when the non-growth catalyst, deals, margin, transformation, buybacks, that's when those other catalysts for stock movements can come into play. And I think Netflix now, it's right at that stage. It's no longer a massive growth stock. It's now a company that can actually move the needle based on these operating metrics. And I think that's actually something to think about. And I want to just point out, to me, it's holding this pullback, and the numbers, earnings, revenue beat. And, it's a serious pullback without the continuation. It's been sitting here for like 2 weeks. So Netflix and Meta. Now, it's also interesting. Borg Warner. They do something with, I'm not sure what they make on cars, but they make parts for autos. Been a bad one for a while here. A lot of bad news on EV problems, gaps down on earnings, gap up on earnings today. Another one, Texas Instruments, which is actually, they make a lot of chips for cars, and they gapped higher in earnings. So, these stocks, and you look at them, these charts are, they're kind of at the top of their ranges and stuff. But then General Motors. What's interesting here, when you look at a name like General Motors, this to me is an opportunity for people to maybe be thinking about things like calendar spreads. And the reason for a name like this and a name like General Motors is, first of all, it trades at a very low multiple. You can go to our fundamentals here, and you put in like GM, and you can see price to earnings on this is 5 times earnings. It trades for 0.3 times revenue, and it trades for less than book value. So, a person here who wants to believe that the economy is doing well and this company is just, overall going to trend higher. They're doing some stock buybacks and things. So, this is a stock where you can put together a thesis that it has the potential to continue higher. And for something like that, a calendar spread can be an approach. So let's look here at General Motors. You notice that it didn't update. I'm going to change this here to teal or cyan. I'm sorry. And it's going to now match. So, for example, look here at PayPal, for example, you can see this changes on Option Station Pro. If I go back, put in GM, I had somehow changed my color. So I want to just show you of my symbol linking. All right, so let's now look at General Motors. And now what's interesting is the 46 level is kind of a, potential sort of resistance spot here, that 46. So let's take a look here at the June and the May and the 10th of May. Now, remember, what I'm going to do, I'm going to change my strikes. I'm going to have fewer strikes and not crowd my screen up. So the 10th of May and buying the Junes. Now, the thing is that when people sell, when they sell options again, it can make more sense to focus on things that have that short-term sort of potential to lose value. And you can also look to be holding things that have more expiration. I don't have time to get into it here, but I could be putting theta on here to actually show that. So now, for example, in this case, the person can look at the 46 line and go to the ask, click on the ask. Then we can go down, hold down control, and go up here. And now I'm looking at the 10th of May, 46 calls, the bid. I'll hold down my control and click on bid. So that means potentially thinking about buying the 46s in June, the monthlies of June, which is the 21st of June, 50 days out, buying those and selling the 46s expiring on the 10th of May. And in this case, that will cost $1. Now, a person could do this strategy and basically reduce. So if these calls here cost $1.27 and you're bringing in 27 cents, you're basically chopping off, you're basically taking away 1/5 of the premium. So say they do that and then they expire. At that point in time, when they expire on May 10th, if you look out 2 weeks into the future, say the stock sits right where it is, or goes up to like 45.5 and it sits there. Well, these 46s will be worthless. Then a person can go to the 24th of May expiration and sell the 46s again and maybe bring in another 25 to 30 cents. And so by doing this, a person can basically eat away at the cost of the 46s here in June that they're long, and they can eat away. Now, the thing is, say the stock starts really rallying, and then the thing is that they can then roll up to a higher strike. So the thing is that over time, this position could be converted into a vertical spread. If the stock starts moving higher, say the stock goes up to like 45.5, and then these first options expire, you can then go up and you could sell a person could think about selling like the 47s on the 24th of May. And if the stock moves higher, they can sell higher strikes. So the thing about something like a calendar spread like this is it allows a potential adjustment over time. And when a stock might have the potential, I'm not predicting GM's going to go up or anything, but if you look at this, it's had good earnings, low valuation, and potentially has space up toward these old highs above 60. So if a person believes that it has that potential to just move higher over a space of a few months, this is when something like the calendar spread can make sense. Another name that popped up is Pfizer. Now, this one I'm looking at, it's near-term overbought, but they had a surprisingly good earnings report. Now, this stock has been a train wreck for a long time, and wanted to just kind of, note that if you look at the earnings report, there was something kind of bullish in it. So this is one that might be starting something of a turnaround. So this is one to be kind of looking into. Next. If a person was to be bearish, JP Morgan here, when you look at this gap lower on earnings, and what's interesting to me is, well, I'm not going to take the time to do it, but you can see there's a potential for a channel there. Now, remember, whenever we look at the options, there's always commissions that fit into that pricing as well. So everything I'm talking about is excluding commissions. So just remember that. But something like JP Morgan, they just kind of stood out to me where if people see potential for downside overall in the market, a potential move in something like JP Morgan, it basically hit 180. So look at a potential put spread here in JP Morgan in June. If you look at this in June, the 180, a person could click on the ask and then look at the bid. And we're looking at basically the 185, 180 put spread costs $1.02. So that's something that could potentially be about 4-to-1 risk reward if JP Morgan goes back to its recent low. So I want to just kind of point that out. If people are expecting the market to push lower, that this is, a name here that is at the top of its range. It's broken down. It has basically retraced pretty much all that drop. And, this is one that might potentially, when you look at it technically, people might look for a retest back down toward those lows. Another thing I want to show you is what's been happening with silver, because silver popped up for the first time. SLV, for the first time, the SLV popped up. I'm going to go to studies, add study. I'm going to go to volume, all options. I'm going to make the lines a little thicker so you can see them better. But silver has now some serious options volume popping up on it. I want to just kind of point that out. This has a significant pullback here to these levels. SLV has now joined the rankings among the most active underliers that we look at, based on this activity in the last month. And it's interesting here to look at the way it's pulled back to this old high. I'll also go over here and look at silver on this chart because it's right down where It's at the bottom of the Keltner channel. So remember here, if we go over here to our price grid and put in SLV, you're going to see SLV. The Keltner pullback shows 6%. That means the current price is basically 6% off the width, the low of the Keltner channel. What this tool does is this indicator looks at the overall size of the Keltner channel, and then it shows where it is in that range. So the Keltner channel is $2 wide, and you're basically 2 cents off the low. It will then show 1%, for example. So this shows that it's pretty near the low, So I want to just kind of point that out. If people are looking for continuation in silver, this is actually an area here where it might grab some people's attention. Now, obviously, something like silver has that sensitivity to the data we're going to get tomorrow from the Fed. So now I do also want to point out that I'm not sure. Let me just quickly show you here on Trading View, because on I think it's better to show you this chart. I have this long-term chart here on Trading View of the 10-year. And if we look at this, TNX, the week, I have it on the daily chart. Basically, we talked about this kind of these series of higher lows. And there is this level here. There's this gap from 2nd of November. That was when we had when we had a really good number on productivity and stuff back here. And the market, the yields gap lower, and the market rallied on that. And now you can see we're back testing that level. So I've been watching this level as really pivotal to kind of determine where things are. And so here we are pulling back from it. But again, tomorrow that jobs report could be pretty important. And then, like I said, the CPI on the 15th. This month is actually interesting because PPI is 1 day before CPI. So just bear that in mind. All right, let me just zip through some of these other things I wanted to quickly mention here. Actually, one thing that jumped up here, I did want to, V-Shop's Chinese name. This one is just interesting to me because it had a strong earnings report here. And then if you look at the, this is just another one. This is another one of these Chinese e-commerce stocks. This one here, I thought this was kind of interesting to see this trend line. Now, I will point out that V-Shops, this stock used to trade like a ton of options. These companies have really lost the options activity. Trades 1,000 contracts a day. I mean, this thing used to be, I'm working with memory, but we can actually look over here. This thing used to trade a lot of options. So let's go here and look at our data. I mean, look at where this thing used to be. And if we change this data to look at, more time. All right, so we have a lot of history here. If we look back over time, I mean, this thing here used to be averaging, well, at one point, I mean, this thing was, this used to average, 10, 20,000 contracts a day. So this has been a very active name. And what's interesting is, I just think it's interesting to see you have that trend line falling here. And look at how it's making a higher low on the weekly. Isn't that interesting? And had that bullish earnings report. So V-Shops was one that had just popped up that I wanted to mention. I had it on my quick little list. Let me just actually shoot through some of these things here that I did also want to mention. This information with Baidu and Tesla. It's kind of interesting because one of the things it tells me is in a bull market, things that are supposed to go wrong don't go wrong. Things come out of nowhere, like suddenly Tesla announces some bullish news or something. So to me, this was an interesting thing to see. This was the Fed statement. They basically talked about reducing QT. What is this here? This was interesting. I mean, overall, there has been, this is S&P Global, but they talk about something to boost transmission, electrical, EV stuff, electrification of the economy, stuff like that. One name that has been on my list that we've talked about, and I think it's interesting to take a look at again, is Freeport-McMoRan, FCX. That is the go-to copper stock that's out there, and their earnings were good, hit a new 52-week high, pulled back. But this is a name that people might want to be looking at as well. Again, here it is sitting at that 21-day exponential moving average. That's a potential sort of thing. I mean, it's volatile, and you have the whole potential for, copper getting hit if there's a strong jobs report tomorrow or something. But want to kind of put that on people's list as well. It's another name that people will go to as a China play, as an electrification play. All right. I want to just point that out. This just kind of snuck by under the radar. Here's another article saying copper demand to boom. This is some kind of Singapore. I think they're Singapore. There's people like in Asia and stuff who are they're big on commodities. Some of these commodity people are not names you've heard of, but they are important. This is, I think, a Singapore broker that's actually pretty important, and they basically had put a bullish note out on copper. Tony Sacconaghi basically came out with a bullish note on Apple. And the big thing with Apple now, people gonna be watching, is the Worldwide Developer Conference is, I have it on my other screen here. It's on June 10th through the 14th, and the expectation is AI. So basically, Bernstein says that Apple has all the bad news has now kind of been priced in. Earnings tonight, so it's interesting to see his note on that. But I also think it's important to realize here that the big catalyst now in Apple is the event on June 10th, the Worldwide Developer Conference, when they are allegedly going to start waving the AI flag, so to speak. I thought this is interesting because you got to be careful. A bull market climbs the wall of worry. So we don't want to place too much emphasis on it. But this Chicago Business Index was really bad. The Dallas Fed Manufacturing Index were both negative. I'm not sure they matter that much, but I want to just kind of point that out. This thing from CVS was a really bad earnings report. They have more people using medical services. This is just something that has been interesting. The stock got just crushed. Walgreen Boots has also been in a similar situation like this. So I want to just mention that, this is something else. I mean, I do see to a certain extent, I want to see the numbers when we get the update from FactSet on Friday. But I mean, there are things here that make me suspect that the overall earnings growth of the S&P is not going to be as terrific, because some of these earnings reports, things like Starbucks and CVS and things like that, these were pretty significantly bad news, Caterpillar as well. Here's an interesting note from Tom Klaza. He basically is saying here that oil has more or less peaked for now. I want to just point that out. He said, this is Tom Klaza. He's an oil expert, but he said that he thinks April 12th was the high in the first half for crude oil. This was Marriott. Also, I thought was just kind of interesting. Not an actively traded stock, but it says something about consumer side, McDonald's. And they talk about, in this case, low income people or just, ordinary Americans. And I think we saw the same thing with Starbucks. Starbucks. Here's that earnings report. Norwegian Cruise Line. We had put out a trading view idea on CCL. And in my view, something like CCL here is the sort of thing where if we get a spike in interest rates, a name like this, people, there might be some potential for a move down toward these lows. This company has a ton of debt. Look on the fundamentals workspace here. If you put in CCL, it's one of my favorite, simple indicators, which is basically enterprise value to market cap. EV to market cap in this is more than twice the market cap, and that enterprise value basically includes debt. So when you see EV to market cap significantly above 1, it means a company has a net debt position. Look at a name like Alphabet here. You'll see their EV to market cap is under 1. That means they actually have no debt on net. They have debt, but they have more cash than they have debt, which means they don't have any from a net basis. They have none. So EV to market cap is an indicator we've created using TradeStation's easy language. It's very simple. It can apply to lots of companies over different sectors. And I think it's a really useful go-to indicator for people who want to have a quick understanding of a company's credit worthiness. In an environment where interest rates are rising, companies with a lot of debt can be at risk. If we are seeing a sort of consumer weakening, some of these names like cruise lines would be that sort of thing. But these companies have, if you look at them, they have significant debt. And if interest rates are going higher over the long term, that is potentially a risk to things like the cruise lines and stocks like American Airlines as well. What's this? This was, all right, so here was one of these Asian things. All right, so the top securities regulator rolls out 5 measures to boost Hong Kong status, which just kind of shows as an international financial hub. This shows what's happening in China. So this was on the 20th of April, and they said on Friday. So this was, within the last 2 weeks. The China Securities Regulatory Commission on Friday announced 5 measures which are to be implemented jointly with the Hong Kong Special Administrative Region in a bid to enhance the Stock Connect and support the strengthening of its status as an international financial center. So this was the thing. And what's interesting is after that, UBS and I think Goldman, right around the same time, started putting out bullish notes as well. So these guys, for whatever reason, they maybe knew about it, or they actually just saw the risk reward, just kind of I think, interesting to see that. Here's the Caterpillar, like I mentioned, that was negative, and those are the all right. So those are the main things I wanted to cover. S&P kind of pushing back up toward its high of the day, kind of retracing that candle from yesterday. So just remember, we have these two things at play. Something like, potential bearish flag. It can look that way, and I just think right now we have some potential of the negativity building here, but at the same time, it is priced in when we look at things like the AAII, or at least it's expressed already. And, we could just be in a spot where a pattern we've seen in this market is that it, pulls back, people get skittish, and then there's no one left to sell. And then before you know it, it continues higher. So it has been a pattern. I want to just kind of point that out. And remember, Apple tonight, non-farm payrolls in the morning, and then we have a 2-week period before we get to that CPI. So it's great to talk to everyone, and we'll be back on Thursday, same time here at Trade Station. Great to talk to everyone. Have a great day.